With a 100 grand funded account, your trading is going to take a huge turn. There's no doubt about that. But there's one trap that most people fall for, and they end up paying a lot more times than they would have to, buying funded accounts, paying hundreds or even thousands of dollars for it, which is not something that you have to do if you avoid this trap. By the end of this video, you will know what the best way to get funded is, but we first have to see why being funded is so crucial for trades. Right here we have the Euro-US dollar, and when we look at the daily candlesticks, we can see that the market has been ranging approximately since last year, June. But now since the beginning of this year, there's been a downtrend going on. However, it's still trading around this supply zone right here. It's still in the lower end, and it's not clear whether it will still continue to go down at this point. When we now take a look on the hourly time frame, then we will see how this obviously, after this candle, may have been an inflection point, considering that this is the lower end and therefore a supply zone of the strengthening market. Therefore, with this bearish engulfing candle, this was by itself already a setup that you could have traded with a tight stop loss, but I'm especially interested in this because three indicators actually aligned, which is the price action, the candle right here, the RSI being oversold, and the supply zone, indicating that this is a high probability setup. So that's a trade that you actually could have taken. And I've drawn the boxes around here. As you can see, if this was your risk, you would have made approximately 2.5 times your risk multiple if you sold at this level where the market moved into oversold territory, just so barely, and then candlestick confirmation contraindicated the trade. However, you would not have taken the short position right here because there was only two things aligning and no thing aligning on the higher time frame as we saw in the daily chart. Alright, so this would have been a trade that over 2 days would have made you 2.5 times approximately your risk, depending on how you would have set this stop loss. 2.5 times your risk if you risk an aggressive 3% per trade, which is a lot. Most people aim for 2%. Then on a $1,000 account, that would have made you $75 in the span of 2.5 days, which realistically is nothing. You're here monitoring the market many hours of the day, doing that in many markets, learning about many strategies, and you just get $75. And obviously not all of your trades are going to be wins. Therefore, this is measly. This is nothing. This has, as I like to call it, negative opportunity cost. If you trade like this, there's basically no point in doing that long term. However, on a 100k deposit, risking 3% per risk multiple would have resulted in $7.5 thousand, meaning that on 100 grand, this is worth every second of your time spent, because that's a lot of money. Now keep in mind there are caveats, one of which is very important, we're going to talk about later. The first one that I have to mention right here is that you won't have every 2 days a return of 7.5%, because first of all, as I said, not all trades are going to work out. And second of all, not every 2 days you're going to find a trading setup such as this one, where three indicators align. That's just not going to happen, especially if you move on these time frames. If you go lower, you may find more setups, but your time investment will be much higher as well. To make this a little bit more concrete, I've actually created this spreadsheet right here. If you have a strategy with a 50% win rate because you target a higher risk multiple, which will likely result in such strategies that will only work half of the time, which is fine as long as your profit factor is above 1, and you make 3 times your risk with every trade that you take, that would mean that your profit factor is 2, meaning that before fees, you are a profitable trader. Don't be afraid of the numbers. Here's where it gets interesting. Because if you take 3 trades, 3 weekly trades, that's 12 trades per month. If you risk 3%, that's per month. I've calculated this for you here. That's $720 on a $2,000 deposit that you are making per month. Now think about how much time you're investing into this to make these 3 trades. Probably it's manageable, but it's basically not worth your time. When you're trading like this, you will make more money monthly with minimum wage. Unless you're learning right now, there's really no sense in doing this long term. However, with the exact same strategy, but not doing this on 2 grand, but 50 grand. It's the same strategy, but it would yield 18,000 US dollars. Here, other than with non-funded accounts, the opportunity cost is negative, because the other thing that you could do is way worse. You would rather do this. I mean, if you would instead work a job, you would make much less money than if you just keep trading and make 80 grand per month. However, of course, if your funded account is only a tenth of that size, then we have to adjust the parameters like this. and it's a much more reasonable number. However, if you get more than 3 weekly trades, these are all trades profitable plus unprofitable under these conditions right here, then $6,000 in monthly revenue is a very respectable thing. Especially if you've nailed your strategy and you can go intraday and day trade, and you can take more than 5 weekly trades perhaps not, then you will make more than this. All of this to say, even if you have a working strategy, it's the same strategy. You're not going to make money if this is just your $2,000 normal account. You actually will need a funded account in order to generate meaningful profits with trading. Otherwise, you're kind of wasting your time. It's going to be actually being funded that will make the difference. But here's then the key mistake that people make, because people will buy funded accounts prematurely. So what do I mean by that? They will look at a chart and they will see right here, oh, the market reacted right here, there was support, there was candlestick confirmation, and I would have taken the trade. So they would have thought, all right, this is the arrow, let's draw an arrow. I would have entered here. Maybe they even, in retrospect, say they would have entered here. It's obvious for whatever reason they will say. And they may say RSI plus candlestick, so actually it's going to be here. I would have taken this trade. And for some reason I would have exited right around here. Or maybe they are more realistic and would have exited here. Whatever the case, if they think, oh, this market movement, there's RSI plus candlestick alignment, and the market moved, so this is my strategy, I'm going to apply this on a funded account right now, then the problem is, once they do that, right here, there's RSI and there's candlestick confirmation. This candle right here, as you can see, is engulfing. And so they enter a trade, but obviously this was not the take profit and they get stopped out right around here or here, depending on where their stop loss was. And the mistake that they do is they look at the charts and they see market movements and they will see, all right, the big move happened here and the big move happened here. How would I have needed to have my rules in order to have profited from these trades? They will, in retrospect, make up rules, but they won't test the rules in every situation. And the worst thing that people may do is they may have different rules for other situations. For example, if this trade would have gone down right here, they would have rationalized it in saying that would have exited here already. However, when the market would have gone further up, they would have said they would have exited here. So do you see what I mean? To summarize, they in retrospect make the rules such that they would have profited from the market. And that's not the way that you properly derive a strategy, because for testing a strategy, you will need to test every signal that the strategy gives you, not cherry pick ones, except for case studies. But then the next step is always going to be testing all of the strategy's signals to see whether it actually on average works or whether it does not. And when a trader will does this, then they will see that actually the RSI plus candlestick confirmation is not enough to be profitable, but the RSI plus candlestick plus higher time frame support may be, because when we look at it again from an hourly, or let's go 30 minutes perspective, there's been a resistance zone right here and liquidity was taken from it. And now in the 2-minute chart, the market was overbought and there's candlestick confirmation. This may have been a trade that they could have taken and they could have profited from this very trade. However, not that fast though, because the market still reversed sometime after. And what a trader now cannot do is justify themselves that they would have exited here when they said right here that they would have exited on overbought. But mind you, this trade would have needed the same exit rules as this trade right here. And if a trader doesn't have this, I also mentioned this in my free guide on how to become a profitable Forex trader. If you don't have the same exit rules for each trade according to the same strategy, then you are deceiving yourself and you should definitely change that. Now with all of this in mind, here's my recommendation. First, you need to derive a strategy. Test the signals that the strategy has and see whether across market conditions it is actually profitable, and if it's only profitable in a certain market condition, then how can you filter for it? And once you're confident that you have this profitable strategy, then you move on to the next step. I should have done this in a different order, which is wait for a good setup. Because when you buy a prop from challenge, for example with FTMO, through the evaluation phase, you are not time constrained at all. Just wait for good setups to occur that are according to your strategy. And when you do that, then over the long term, your good setups will get you funded on this account, because A, your strategy is working, and B, you are applying your strategy and not something else half-baked. To actually do this, I advise you to write your strategy down, because once you have written it down, then you can reflect every trade. Did this fit my strategy? So that you can't really justify your trade when in fact the written down rules are different. And then you want to apply it obviously on the funded account challenge, but only with tight risk management. All of this doesn't matter if you blow your risk management, because obviously the prop firms don't want to risk their own capital. And so in the evaluation phase, in case you don't know how this works, they have a maximum drawdown and also a maximum daily drawdown. So once you have a profitable strategy, just follow these steps that I just mentioned. This is basically a summary of this video. And in case you don't know how a prop firm works, this part will be interesting for you. So you register on a website for a prop firm, and there you will pay an evaluation fee to trade on, usually with demo capital. And if you pass that test and they deem that you are a good trader, then they give you, for example, $100,000 of the prop firm's money to trade on. Then from these profits that you will hopefully make, if your strategy is working, basically only if your strategy was working, only then you will pass the evaluation phase. Then you take the payouts and you keep most of your profits, but not all of them, of course, because the prop firm provides money. And that way you make money as long as your strategy works. Be careful though, there's a lot of firms with a bad reputation here, but legit firms do exist. And lastly, I want to encourage you to write a comment on your thoughts of prop firms and maybe the experiences that you have had with them. Also, if you're still working on your trading strategy, and I've written a 1,400 free guide on it that you can download by clicking the link in the description. Subscribe to the channel, like this video, turn on the notifications, and write a comment with your thoughts.